Hey Money Vikings, welcome back to the channel. I wanted to do an interesting one today. I want to go through the median 401k balances by age. And I find this actually very helpful and eye-opening and informative. The scary part about this is that most people are totally unprepared for any kind of comfortable wealth building or retirement if you look at the median figures. I am on NerdWallet, that's where I'm getting my data today, but I wanted to talk about what this means, and I wanted to talk about what we can all do to improve if this is where we're landing in terms of the median. So thanks a lot for joining as we grow the channel. Please consider liking, subscribing, and sharing our Money Vikings content. We do appreciate it. So without further ado, let's dive right in. So I did bring out a calculator as well because I want to talk about beyond these numbers, because I'm a big proponent of understanding what these numbers mean in terms of income, because that's the critical thing here. People get very fixated on the big number, right? The 200,000, the 400,000, the $1 million. And then they get very scared when the market goes down if they're heavily invested in equities or stock funds. And basically they lose sight of the big picture here. And this is something I'm always trying to push and get this message across, because I think it's absolutely critical to wealth building, because wealth building is stopped by fear, okay? And what happens is people will, let's just use a number. Let's say they get to a point after several years of investing and saving that they get $300,000 in their investment account. Let's say it's been like the last 5, 6, 10 years in the market overall, where the market has done very well. The S&P 500 is what I'm talking about. So what happens is they get 300,000, and then, which could happen any day, there could be a market correction, as they call it, where the market drops 25, 30% in one day. So overnight, let's do the quick math on that. If they have 300,000, let's see here. Let's just do 300,000. Let's multiply times point. Let's see what 30% of that is. So they could lose $90,000. Okay, so they could lose $90,000. That could go to $210,000, and they freak out. They sell it all. I'm never going into the market. What they're missing is, if that person is, for example, 30 or 40 years old or 25 years old or whatever it may be, in the younger side, they're not realizing that they're not accessing that for income until they're 55, 57, 65, etc. So they really don't need to worry about that huge correction. And the other thing is that they're never supposed to be taking it all out at once. It's supposed to be a quote-unquote nest egg, but I like to call it a passive income machine. So you're building that $300,000, $500,000, $1 million portfolio. You're diversifying properly with your own risk tolerance. You're trying to beat inflation and grow it. But then what's happening is you're creating a system where you can withdraw maybe 4, 5, 6,000 a month very safely over decades. So I just have to push that. That's very critical to wealth building. But let's look at some of the numbers here. So as you can see here, again, I'm on NerdWallet. Under 25s are, you're looking at $2,800 median 401k balance. This makes a lot of sense. A person that's under 25 years old is just starting out, is really just trying to get their career going. So you're not going to have much. The critical thing at this age is to start doing something. And please, please, please get that match. People so often fail to get the match, and that is so detrimental to their long-term wealth building. But even if you didn't start at 25, you can start later and still do very well. So in this country, 25 to 34-year-olds have a median account balance of $14,000. This might be all right for a 25-year-old. I find this a little bit shocking for someone in their early 30s. It should be a lot more than 34,000. Let's say that they're making, I don't know, 75,000 a year. Okay, and they're contributing, let's just say they're contributing maybe 5, 6%, and maybe they're getting a company match. Let's just say they're contributing 8%. Let's see what that is. Okay, so that's $6,000 a year, and that's pretty conservative, right? Pretty average salary, average investments. And then that's also grown. And let's say they've been doing that for, if a 34-year-old, let's say they've been doing it for at least 5 years, I would hope, right? They started at 29. So times five, 30,000 plus some market growth. I don't know, let's add another 12%. It's probably more, could be more, but 36. Okay, so let's just say that should be more like 35,000, I would think. 35. So that should be probably double, I would say. Okay, but that is what it is, and the person has a lot of time to catch up and add to it. Okay, 35 to 44, you're talking about 35,000. See, I think that's really where a 20, as you can see, a 25 to 34-year-old should be. And so this starts to get really, really depressing to me for a 44-year-old. Again, on the younger side of that range, 35, that's one thing. But if you're on the older side of that, so if you're at the 43 years old, 44-year range, I mean, at that point, you might have had almost 20 years of investing in a actually really good market times since then. There's been some dips like with 9/11, the Great Recession, and the pandemic. But after every time, if a person didn't freak out, that came roaring back. So that to me should probably be triple in this country. That should probably be at least 100,000 would be, I would say, much healthier. Okay, so 45 to 54, okay, this one is just downright depressing. So at 45 to 54, to have 60,000 in a 401k is really rough. And let's do some quick math. The problem is, so on the older side of that, let's say 54, that person could be, if they're not forced out of their job, that person could be anywhere from 5 to 7 years from retirement. Okay, so coming up relatively quick. Let's say that 60,000 grows to, let's just say 100,000 by the time they retire at this rate they're going. $100,000, and then if you use the conservative 4% rule, let's even use the 5% rule. We all know what this is. That's going to generate, that only generates $5,000 a year in safe withdrawal income. $5,000 a year divided by 12. Holy cow, let's look at that. That's 416, and then you got a lot of sixes here, which is not a good sign. So $416 a month. So again, that's a number at this range here that should be, I think that should be like 4 times that. That should be more like 250,000, okay? So then 55 to 64. And remember, median is important. I'm using median because average is really misleading, because there are people in the average that skew things way out of whack. There's really, really high achieving savers, investors that could have millions, and then most of the people have 20,000. Let me show you what happens. So there's a quick way to do this. Let's say there's 4 people, okay, and one of them has 1 million, and the other 3 have 20,000. Okay, so we're gonna take 4 people. We're gonna take 1 million. It's gonna be okay. I know what it is. So the other people have 20,000, which is very low. Okay, that's 60,000 total for those 3. That's 1 million. Let's say 1,060,000. Let's see if I can do this in the calculator right. 1 million. I think I gotta add bear with me here. Let's see. 1 million. Okay, and then I think I did this wrong. Hold on. 1 million. Let's see. I got the third one. Okay, bear with me. That's 10 million. Okay, hold up. Let's just say, okay, 1,060,000. I got to get the zeros right on this thing. Sorry, I'm very visual, so I have to actually write this down in order to 1,060,000 on that guy. So I'm going to 0 there and 1. Okay, I got it. See, I'm just visual. All right, so let's do this. So 1,060,000. It's 060. Okay, let's see here. 1, 2, 3. Let's see, that's 4 zeros there. Got it. Okay, so yeah, 1 million. There we go. 1,060,000. Okay, divide that by 4. Divided by 4. Okay, equals. Okay, see, that creates an average of those 4 people. Okay, the average then becomes $265,000. Well, you know, that's totally not accurate. 3 of those people have 20,000 and 1 has 1 million. So you can see that's why we use median. Median means it's the person in the middle. Half the people have an amount below that and half the people have an amount above that. So we're going to use median here. And so then you get 65 and older and the median is 88,000. But that means 50% of the people with the 401ks at 55 to 64 have less than 87,000. So just use these numbers. Most of you people who are watching this channel are financially savvy, right? I know the audience here. So you're financially savvy people, and you're gaining more knowledge and inspiration here. So use this as inspiration would be what I would say. And just make sure that you're not in this median. Make sure you're well above it by automating, of course, trying to increase those contributions as much as you can, staying out of bad debt, all that good stuff. So, hey, thanks a lot for watching, and we'll see you on the next one. Take care.